welcome to the live stream. Let's see what the market's doing today and see if there's any opportunities to get into some stocks. Let's evaluate stocks and look at their fundamentals. Sometimes stocks are popular, but I want to make sure they're valuable. If you look at the best companies on the stock market, the most valuable ones, all produce high free cash flow. That's why I'm looking for high free cash flow. All the best investors depended on free cash flow and evaluating a company's ability to generate free cash flow. A company is not the stock price, and the stock price is not the company. They're two different things. Two different things. The big cap stocks have taken the show, but are big cap stocks going to come back? Chinese stocks are exploding. The dragon has awakened in China. It could be the best trade we've seen in a while.
Hey everybody, welcome to the live stream. We're going to get going in about a minute or two. Hang tight. Wanted to let a few people in. Give a few minutes for people to come in. If you're interested in a stock and you're a member, please
really
put it in the chat.
AI is going to be interesting in the future, but is it really a business today? I'm going to pass on this stock. Just not enough discount, and I'm not really believing that they're going to grow as well as they should. Options can make your performance go a little higher every month and generate nice income. Listen to the great super investors. They are pretty generous
Heck of a day,
with their
man.
knowledge and their wisdom. You just got to read their books and listen to their videos. Learn something new every month.
Week was down.
In investing, you'll become a great investor.
It's going to happen next week.
This is a buy stock. You're looking at a discounted stock, and it's unappreciated at this time. Don't forget about bonds. Bonds are a smooth, consistent way of earning a good return. And when stocks are really crashing, bonds stand up tall. Bonds stand up tall. You got to ring the cash register and take a gain. Defining when to sell a stock is a lot harder than determining when to buy a stock. And over time, you'll become a great investor and you will build great wealth.
Hey everybody, welcome to the Friday afternoon, Friday evening live stream. Man, I wish we would have
welcome to the
had
live
a better
stream.
day today, but man, I can't create miracles. And the market sold off today quite aggressively due to the conflict between Israel and Iran. I hope that gets resolved quickly. Not a lot of people get hurt. But that really drove oil prices up and it drove stock prices down. As we look at the week for the S&P, it was down 0.37%. So it ended up being a bad week. For a while, it was looking pretty good. First couple of days of the week, I mean, the market was headed up first 2 days. And then from there, it came down. Came down from the high point, 1.32. This year has been about knowing when to buy. And boy, we had some really nice discounts back in April, huh? Really nice discounts. So having a nice correction is maybe something we have. If we're prepared, we can make some money, right? What this channel is about trying to get better each week, each month, each year. Long-term investing, looking for great businesses, preferably growing businesses that have great margins, that produce great free cash flows, great profits, and the market doesn't really price them correctly. They have them discounted. that's what we're looking for. It's kind of, we're looking for the right conditions so we can invest our hard-earned money, make a lot of money over the long haul. So that's what this channel focuses on. When you look at what I analyze free cash flows for a company. We're going to take a look at a few stocks that members of the channel have asked that I take a look at. And we're going to go through the cash flows. We're going to go through the earnings per share. We're going to determine what those stocks are worth based on their cash flows, determine what they're worth based on their earnings per share, the profits, and then compare it to stock prices and see if those are good buys or if they should be sells. So that's what the channel's about. I welcome you to become a member. It'd be great to have you as a member. We've been getting a lot of new members, and I appreciate every single member of the channel. We have member calls. You obviously can attend the live streams, put up tickers, and I'll take a look at them. No additional fee. If you're not a member, it costs $5 per ticker, and I'll take a look at the stocks. You know, I'm open to non-members putting a stock out there, but I want to make sure that it's equitable to the members. I don't just give away something that they paid for. So consider that. If you'd like for me to look at a ticker, please put it in the chat. All right, so let's get going here. Got plenty of time this afternoon, so let me know if there's something you want me to look at. So the market itself had a bad day, and principally oil went up 7.42%, and now oil is in the mid 70s. I mean, we were spending a lot of time in the 60s, and oil companies now can really flourish, especially if this conflict lasts a long time and Iran, basically their oil is taken off the market. That takes a lot of supply off the market, and it causes higher oil prices, which is what we're seeing. And it's going to make the big oil companies, it's going to make the oil exploration companies far more profitable. So right now we're seeing those stocks go up. And I'm going to take a look at Devon Energy. I'm going to look at Oxy. And while I'm at it, I can look at Chevron and maybe look at Exxon as well. So let's keep going. So we've got high oil prices, and you know, energy stocks haven't been doing great, but now they're having a good day. Looking at the heat map, energy was the only hot, green spot in the market. Everything else was red. I guess aerospace and defense also was a nice green area, because if you have a conflict, that means the government's probably going to order more planes, more missiles, and so forth. You see Raytheon is up. Lockheed Martin is up. Raytheon, and a couple others. GD, I think it's guidance. So those stocks are doing good because of the conflict. Tesla had a good day. Interesting. And it looks like healthcare had a decent day. But energy, that's where the money was at. And today, it looks like some stocks had a really good day. Devon was up 2.42. Oxy was up 3.8%. Nicely done, Oxy. Like seeing that in Occidental. So the sectors. Now, each year, some sectors do better than others. Last couple of years, and really recently, especially recently as well, technology did great. But now technology is kind of down here, right? It's not number one. Healthcare is number one. Materials, utilities, communication services. So I like looking at this because it gives me kind of a wide vision of, hey, where could I look for some new stocks that could really reward me as an investor? It looks like healthcare stocks are making money. So that's an area of interest for me. And historically, healthcare has been a really good sector for me. So I'm good with that. Looks like Josh, how you doing, man? Happy Friday. Materials as well. Materials has been working for me, and I don't own a whole lot of materials, but the ones that I did start to buy into, they're all winners. I own 4 material stocks. They're all making money. That's great. Because materials, they're going to go up as commodity prices go up. Steel is going up in price. Gold went up big time. And on a day like this, gold went up a lot. Copper continues to go up because copper is it's in such high demand because it's used in so many products. So material stocks and healthcare stocks are at the top of the stack, number 1, number 2. And when we look at the big name stocks, right, these are the most valuable companies on the exchange. We got Microsoft, 3.5 trillion. They're having a good year, up 12.67, far ahead of the S&P. Nvidia is having a decent year, 5.72 ahead of the S&P. And its market cap's 3.4 trillion. Apple not having a good year. It's down 21.55% year to date, and it had a bad day today. So that one's got to be in a lot of people's portfolios. And if you look at ETFs and mutual funds and so forth, Apple is all over the place. A lot of big institutional investors own it. So I'm sure there's a lot of angst around that stock. Amazon is down a bit. Google is down. Meta's having a very good year, up 16.63%, way ahead of the S&P and ahead of the rest of the big names. Broadcom's having a good year, and Berkshire is still having a good year, even though since the announcement that Warren Buffett was going to be letting his successor take over, the stock is down substantially. So that one there will be interesting to see if Berkshire is going to end the year in the positive or it's going to be a money-losing stock for investors. That'll be interesting. Tesla is down substantially, but it had a good day. And then TSM is having a decent year. So the big names, depending on which one you're in, you're either doing really well with Meta, Microsoft, or you're really hurting with Apple. And even Google has been kind of a loser. And then Tesla's been a real downer. I want to take a peek at China. Look how good these China stocks have been doing. Alibaba up 32% year to date. NetEase up 45%. Tencent up 62%. This is all year to date. This is like 5 months and 2 weeks. We've got Li Auto up 16%. Xpeng up 53%. Futu up 42%. These are really, really good numbers. And the number one super investor, based on the rankings that I have, based on their performance, is Tepper, David Tepper. And he owns a lot of Chinese stocks. Well, this is why he's number one, is he picked some of these stocks and they're flourishing. So China is really doing well. And China's not kind of in the, other than the tariff negotiation, which I think is going to get resolved, they're not in the center of any controversy. China's kind of just doing their thing. So hopefully that continues and these Chinese stocks will continue to flourish. So China stocks are doing well. So that's kind of a quick overview of markets. What I wanted to do is jump into Devon Energy. I'm going to look at Oxy and kind of look at these stocks because they really flourished today. Oil prices went up. Devon went up 2.27. This stock pays a nice dividend of 3.73%. Analysts think it's discounted by 23.75%. The stock is down over the 1 year by 25%. And it's because oil prices were down. If you have low oil prices, Devon, which explores for new energy, it goes and finds where the energy is, the oil. Goes to oil fields, finds where they should be drilling, drills and extracts that oil and then brings it to market. That's what they do. Similar business is Occidental, and I'll look at that next. This is a market cap of 22.5 billion. So it's not humongous. It's just a pretty good sized market cap. PE is 8, and that's because oil prices are lower. But as you increase that oil price, we're in the mid 70s, right? These guys are going to make money. If it goes up to $100 a barrel, you better believe this stock's going to take off. Now, buying these stocks, and I'm going to look at Occidental and I'm going to look at Devon. So if you look at where this stock is traded, it's been going down, down, down. And it was a good idea. I did not buy Devon, I bought Occidental. And I can explain later as to why I bought Occidental. But let's kind of chart them. They're kind of following each other. And the point I was going to make is you want to buy when nobody else wants to buy, right around here, right? And that's when I started to buy Oxy. So it's already been a good one. And Oxy, I'm making money on Oxy, had a good day, and Devon would be the same thing. You want to buy when nobody wants to buy the stock. You know, historically, these stocks are going to rise because historically, oil prices will move up. Historically, there tends to be conflict in these oil producing countries. And here we are. Here we are with a conflict that's going to raise oil prices. So getting into these stocks at the right time is a really good move. I think there's more upside if oil prices keep going up. Yeah, Devon's going to keep going up. Occidental's going to keep going up. How you doing, Neil? Good to see you. And when I look at which super investors own Devon, right? And Devon is owned by, I'm going to say two super investors. First, Mike, the dividend investor guy, he owns Devon. And then the second is Yacht Man Asset Management. They own it. Not a very well-known super investor. But when we look at Oxy, of course, the great Warren Buffett owns Oxy. Actually, 7 super investors own Oxy. Whew. So Warren Buffett owns it. Lee Lu, which is kind of a disciple of Warren Buffett and Charlie Munger. Dodge and Cox owns it. There's a lot of ownership of Oxy. So I like owning Oxy. I think it's a good stock for me. I also own Chevron. And you see that these guys were adding shares. They want to add shares when nobody wants to buy it. Nicely discounted stock because oil prices on average will go up. It's like not natural for them to trade around $65 per barrel. It's probably going to be an $80 barrel average, right? So now barrel prices are going up and these companies are going to make more money. So that is Devon. I can't argue with anybody buying Devon. I like Oxy, but look at Devon here. I've got it priced out. Let me make this a little bigger so you guys can see it. See how we can, how's this? Yeah, I think I could even make it one more level bigger. All right, that's better. Okay. So Devon is 25% discounted, and especially on the earnings per share. It doesn't drive as much cash flow, which is why I prefer Oxy. When I show you Occidental, it drives more free cash flow, which is my preference. But man, if somebody said I want to own Devon Energy, go for it. I think it's a really good stock. And I think it's going to grow better than that. I'm going to grow it by 10% because with the higher oil price is going to do better. So I did change it on the fly. It's 32%. So when we look at Oxy, Oxy's discounted even better in my opinion because of this cash flow. Historically, they've just done better on cash flow. And what I do with oil companies, I use a 5-year average because it's really hard to know, hey, last year, this is what oil prices were like. Well, that doesn't represent this year or maybe the year that follows. So instead, I go 5 years. I think it's a better way of me to forecast where oil prices will be and in general, how much cash flow these companies will produce. So Oxy, in my opinion, is just a better stock overall. And now with higher oil prices, it's going to do really well. So my choice is Oxy, but I can't argue somebody buying Devon. And I know that some guys in the channel own Exxon. Can't argue with that. Exxon's excellent. Probably makes more money than Chevron. I own Chevron. Chevron pays a nice dividend. And in fact, I got paid my dividend either at the end of last week or the beginning of this week. I think it was the beginning of this week. And I reinvested the entire dividend into more stock, which I'm glad because it went up nicely this week. So the oil complex is making money for investors, and The oil companies tend to pay really good dividends too. Let's take a peek at Chevron and Exxon. So Chevron pays a 4.69% dividend for those income investors out there. Look at that. Analysts think it's discounted. The 1 year only lost 5%. So it doesn't lose as much as the Devons or the Oxys. And year to date, it's up a tiny bit. So that plus your dividend, you're doing okay. You're probably keeping up with the S&P. But I mean, I'm not excited about 0.74. If you guys follow my channel, you know I'm like after way better returns than that. So Chevron's a good buy. It's a good. I own oil because there's situations like this. I don't know when they're going to happen, but when they happen, I'm really glad that I own a couple oil companies. I hope it, and again, I'll say it again. I hope the situation gets resolved. ExxonMobil. Okay. So Exxon is excellent. 3.5% dividend. It's having a better year than Chevron year to date. The 1 year, you're back to even. But this plus your dividend, again, you're not breaking any records on a rate of return. But you let that oil price keep going up, and we'll see. We'll see how this stock is going to go up. This stock, I think it was maybe about 15 years ago, 10 years ago, this was the most valuable company on the exchange. This was number one, ExxonMobil. It was during George W. Bush's administration, because oil prices had gotten so high that ExxonMobil became the most valuable company on the exchange. I don't think that's going to happen. If it does, boy, that's going to be a lousy economy because everybody's going to be spending their money on gasoline versus going and buying stuff or going to the movies and stuff. So oil companies, they're having a good day. They're having a good day. Let me check in on the chat here. Neil, good to see you. Looks like you have a company there. Rules of engagement. If you'd like me to take a look at it, I'd be happy to. Just a $5 super chat if you'd like me to look at it. Mike, you own both Devon and Oxy. Awesome. Hopefully they keep going up. Saeed, very good to see you. And thanks for all the good questions that you send my way. And then Josh, good to see you. Yeah, when Buffett and a bunch of other investors are in a particular stock, you just get a little more confidence because, I do all my analysis, right? And if I do my analysis and I think its stock is discounted and super investors are in it, it's just a little more comfortable going into it. All right. So went over those. The next kind of segment, I want to look at Chime, Circle, and Coinbase. So the Circle IPO was really successful. I've been super busy this week. I haven't really checked in on the Chime IPO. So let's take a look at it. And it was down 6% today. It was down for the week. And what does Chime do again? Let me refresh my memory. So Chime Financial, a financial technology company, provides digital consumer banking and payment solutions. It offers Chime, a banking application for providing mobile banking services that address the need of people such as their spending, saving, accessing liquidity, building credit. So these guys are kind of a bank, kind of a credit management company. Okay. Yeah, they're classified as a bank. These guys, it seems like these guys are going to be competing more with SoFi than they would with Circle or Coin. So their IPO, I would say, wasn't like the Circle IPO. Let me visit that one really quick. So the Circle IPO, this company, the market's really excited about Circle. So I am not. Not finding Circle on Google. Wonder why. CRCL. There it is. So Circle's had a really good IPO. It's up 330%. So it's well beyond good. It's great. I think the company is unique because it's providing the infrastructure and the ability to issue out stablecoins. There was huge news today where Walmart and Amazon said we're going to issue out stablecoins, and then customers could pay for stuff on Amazon and pay for stuff at Walmart with a stablecoin. And as you likely know, Visa has a network that these merchants could use, and the rate is 3%. Now, big merchants can negotiate that and basically bring it down, I don't know, to a percent or maybe 2, maybe a little bit more. But what Amazon and Walmart are probably eyeing is, wouldn't it be great if we just got rid of Visa altogether and then we can keep that margin? So that's what they're doing, and they're doing it through a stable coin. So back to Circle. Circle has a platform and ability for more businesses to issue out stable coins and then bring a lot of transactions into that stable coin network. So I think there's going to be a fertile, large addressable market for Circle, and the stocks just really jumped up. I don't like investing in IPOs early, and the reason for it is when we look at this company, it's doing well, right? These growth rates are really interesting. You have 87%, 809%. But you see how from FY 2023 to FY 2024, the growth rate was only 15.57, which is not all that great. All right. I'd like to see more years, more quarters before I invest my hard-earned money. And when we look at their profitability and free cash flow, earnings per share, they do make money, which is good. They're a young business. They have been expanding their free cash flow, which looks good. But that cash flow does not support the stock price, not yet. Their profit margin's pretty low because they're small still. I think as they get bigger, they're going to become more profitable. Their free cash flow margin is very good, by the way. But at $300 million of free cash flow per year, with such a young business, I mean, you're basically paying about 100 times free cash flow, and that's just too high. I could maybe go 30 times free cash flow. That gets me to about 9 billion, and I can't get to 30 billion. And that's my problem with when I look at these IPO stocks, is just too early to tell. And a lot of these stocks, they have a hard time. Look at our friends at Coinbase, which is probably a very good stock to study if you want to see what's going to happen to Circle. Well, Coinbase came out and it was heavily invested into, but it really went down in price, 90%. Wow. It really, really got torched. Well, buying here most definitely was a good idea, because from there to here, you'd be up 600%, which is exactly what I did. Waiting around for a stock to IPO, and then you get better financials, you get a better sense of how they're going to grow, and then invest at the right times. That's what I did with Coinbase. That's what I'd like to do with Circle. Is Circle going to follow this trend where they come out really hot? A lot of investors want to buy the stock because there's a lot of publicity around it. It could be. The fundamentals do not support the stock price. There's a lot of unknowns. What if they hit kind of a lull in the business and they can't grow that well? It's probably going to sell off pretty fast, right? And instead, I'm going to wait around on Circle. I'm going to wait maybe a year and see when it does better. When we talk about Chime is a lot like SoFi, and I don't like SoFi a whole lot. And the reason for it is SoFi is in a lot of ways a bank. Well, there's plenty of banks out there to invest in. There's not enough uniqueness there. So I've stayed away from SoFi. Instead, I've invested in stocks like Robinhood, which has done really, really well. So Chime, didn't do well. I probably wouldn't buy into Chime because I think it's just trying to do what banks do already, just doing it better. The growth rate is not overly exciting. When we look at a bank, we want to look at book value growth. And when we look at their book value, tangible book value is negative. Well, that's not good. The book value per share is negative, and it's getting better. But I mean, these are just numbers I can't get my head around. So I will pass on Chime. Looks like a lot of investors are doing the same thing. They're saying, we are not going to invest in Chime. I think it's a business that is trying to do what banks do already, just trying to do it better. And that's just not enough, big gains, big value, big profit kind of potential. I can understand people being excited about Circle because, as you saw with Amazon, Walmart, I mean, you got some immediate big volume. Those two companies collectively, pairing them together, that's over $1 trillion of commerce. Just off the bat, boom, there's 1 trillion. And if other businesses follow, maybe they see $5 trillion of volume through stable coins. That'd be incredible. So, Saeed, you've got a couple questions. Let me take those. So you agree on Visa, MasterCard monopoly will end? Yeah, that's what drove down Visa. And if you guys have seen my videos for a while, I've been saying this for some time that, the reason I stayed away from Visa is understanding what's happening on the crypto side. Crypto can do exactly what Visa does, which is it's a network. They can basically have a transaction happen. Let's say I went to Europe and I used my Visa card and I paid for something in Paris, France. Totally supports it. Okay, great. So can stablecoins. Stablecoins can be used around the world. Stablecoins, once you own the stablecoin, there's no transaction fee. So it's a big difference where Visa is charging a transaction fee. Visa was created in the 60s. It was created by Bank of America, by the way, and then they spun off the Visa business unit. MasterCard came in later. American Express is a charge card. They don't have revolving credit. It's more of a, hey, pay off your balance when you get the bill. Now, they have a huge market cap, 660 billion. They're not a big growth company. When you look at their growth, 10%, nice and stable. But if you start seeing stable coins take a piece of their market share, and this goes to 8%, 6%, 5%, and it's considered, or I should say the future is owned by stable coins, game over for Visa. They will trade down. This 660 billion will go down to 200 billion quickly because investors are paying for consistency and growth. Okay. Stock's done well for 5 years. Over the 1 year, it's done great. But investors are paying for consistency and growth. But when you look at their profitability for Visa, this is why Amazon is going to do their stablecoin. Gross margin, 97.77%. So Visa doesn't have to spend about anything to collect that money. Well, Amazon and Walmart are like, well, we can do nothing and keep the 3%. Thank you very much. So that's a big threat to Visa. And I think it's real. It's not one of these stories that, oh, what if this happens and that happens? It may hurt this business. Stable coins and crypto are a direct competition to Visa. So are direct bank transactions like Venmo and other peer-to-peer payment systems, because those like Venmo, I don't get charged any money on Venmo. Nobody gets rich on Venmo. And it avoids using cash, using Visa, using checks, and all that stuff. It's a new way of doing commerce. So that in crypto could really start hitting Visa. We'll see how it goes. We will see how it goes. But Visa is a really expensive stock. And look at this PE, 35. That's interesting. But now, stablecoin fears. And I would say it's not a fear. Stablecoin is a reality. Stablecoins have been around now for years. And now, if they get put into commerce, Visa, MasterCard are going to get a piece of their market share taken away almost immediately. You see what Amazon, the impact that UPS and Federal Express have felt when Amazon decided, hey, we're going to do a lot of the deliveries ourselves. We're not going to use FedEx. We're not going to use UPX. We're going to use our own trucks. Well, now FedEx and UPS are really hurting because a big part of their business went away, which is Amazon. Same thing with Visa. If Amazon says, we're not going to use Visa anymore, boom, that's a big chunk. And more importantly, it's going to influence a lot of other businesses to follow the Amazon model. I mean, Amazon's one of the best run businesses in the world. So I could totally understand other businesses following the best in the business. So that's what's going on with Visa, MasterCard. I was never an investor because I just didn't see enough value being delivered to the overall customer, which is me when I use my Visa, or the merchant that is accepting Visa at their business. They're giving away 3% for what? Some small transaction. In 1 second, I need to take a quick. All right, I am back. I just needed to answer the door and get back into the swing of things. Yeah, so I think the monopoly that Visa and MasterCard have had is under threat. And I think their moat is been brought down a couple pegs, and not a big surprise. As mentioned, I avoided the stocks that I thought someday this moat is going to go away. So that is Visa. All right, so, and Saeed, thanks for the questions there. Now, the stock that I have made good money on is Coinbase. Let's take a peek at that before we move off this topic. So Coinbase, as mentioned, it really sold off for really a couple years, but it's really flourished, especially this past year. There's been a lot of stories that, have really helped Coinbase. Principally, Bitcoin is traded up, so the stock price of Bitcoin has been much higher, and that really helped Coinbase. So buying Coinbase at the right times, which the market really offers up really good pricing from time to time. I bought Coinbase shares as recent as April. Good time to buy because it really goes down and then it goes up. So right now, I'm not buying any Coinbase shares, but if it were to drop again, it'd be a good idea. But this stock here has been a good one because if you do your homework, you're able to buy and then make money on Coinbase. And I think Coinbase has a bright future. When you look at their business is doing quite well with the retail buyer of crypto that goes on the Coinbase platform, buys Bitcoin, buys Ethereum, stakes Ethereum, and so forth. But they're also doing a lot of business with brokerages that use Coinbase as the company that's actually doing all the processing for them, because the older school brokerages, they don't know how to deal with Bitcoin and so forth. So instead of taking all the risk of holding all these Bitcoins, they're basically hiring Coinbase to do that for them. So Coinbase is kind of doing institutional management of all these products for the bigger established firms. So that, I think, is another opportunity for Coinbase that I really like. So that is Coinbase. It's part of the ecosystem that Circle's a part of. It's a $61 billion market cap. Let's take a look at the financials, and I'll show you how Circle is very different. So these guys are already up to 6.6 billion. And Circle is at 1.89 billion, which isn't too bad. It's about, let's call it a fourth. But they have a market cap of 30 billion. Less proven, less known, a fourth of the revenue, but they're half of the market cap that Coinbase is. So off the bat, I mean, I'd rather own Coinbase. Now, when we look at revenue growth has been great for, especially the last couple of years for Coinbase. During 2022, when you had a bear market, investors were not buying Bitcoin and so forth. So they had fewer trading fees, so their revenues went down. But once you get trading volumes up, boy, these guys really grew nicely. So Coinbase has been doing really well for the last year and a half. They're also profitable and they generate really good cash. Look at their cash flow. 2.5 billion in the full year 2024, 1.9 in the trailing 12 months. Billion, right? And if you look at Circle, they're at 300 million. So Coinbase is producing 6 times the cash flow, but it's only 2x the market cap. Again, Coinbase looks like a way better investment than Circle. Better known, better fundamentals, better cash flow, better profitability, great growth. Coinbase is going to be the horse that I ride when it comes to crypto. So that's a good kind of pairing of companies that are similar. All right, so Rotel and Cheese, good to see you. Yeah, we went over Circle, talked about it. Rex, good to see you, man. Oh, excellent. EQNR, yeah. EQNR is out there. How you doing, Shadow Guy? Exactly. So I think they are a competitor of BitGo. All right, let me take a look at EQNR. EQNR, I believe, is EQNR. Norway. That's my memory was serving me right, but I sometimes get it wrong. So I'm like, I think it was the Norway oil company. And before I started looking into this company, I didn't know Norway had that much oil, but they do. They have quite a bit of oil, and this stock is looking pretty good. 7% dividend. Today was up 5%. Nice. Year to date, stock's up 17%. Oh, beautiful. Fundamentals look great. PE is 8. Analysts think it's now, I'm going to call it fairly priced, and looks good. Revenue growth. See, with oil prices, these oil companies can't dictate to the market, hey, this is what our price is going to be. No, the market tells the oil companies this is what the per barrel price is. And right now, the price per barrel is going up. These guys probably supply Europe, and Europe is probably going to be light on inventory now that you have this conflict with Iran. So this stock's doing well for the year. Nice pick, Rex. Nicely done. And I think it has greater upside because if we spend time with oil in the 70s, and who knows, if it tries to touch 100 per barrel, man, you're going to see oil prices or oil stocks flourish. It'll be a real bright spot for a stock trading community. It'll look really good. So that is Equinor. Nicely done. And when you look at Equinor, they produce cash flow. They're profitable. Look at these cash flows. Just big gobs of cash going to Equinor. Very good gross margins and profit margins. Now, the one thing that I dislike about Equinor, the reason why I own Chevron and not Equinor, is Equinor does have participation by the government of Norway. And I have nothing against the government of Norway. They're probably just really well run and so forth. I just don't like the idea of a government being in the company that I own. I'd rather own Chevron, which is completely independent of the US government, and Occidental, which is again completely independent of the US government. But I don't know if it's going to be a big deal or not, but that's the main reason why EQNR is not in my portfolio. All the fundamentals and everything else look fabulous. So congratulations, Rex. I hope it keeps rocking. I hope you double your money in 2025, 2026 on EQNR. And Shadow Guy. So is BitGo publicly traded? You're comparing Coinbase. Let me see if I have BitGo in here. So BitGo might be one of these pre-IPO companies, right, that you're interested in. So I think I remember looking at BitGo, and they do. Got it. Yeah. So these guys, BitGo participates in the crypto community. They're partnering with all these companies. And when one of these crypto exchanges is holding coins and staking them, BitGo is involved. Yeah, so I think to some extent they are competing with Coinbase, but Coinbase is becoming the largest kind of player in the space. That's another thing I like. Size does make me feel a little more comfortable. But BitGo could be a big winner, especially if they follow like Circle, and investors are really excited about it. Boy, I'm pretty sure that the BitGo valuation really went up after the Circle valuation or the Circle IPO. They probably went up a lot in value. Good one. All right, Mike, ESTC, and you love SoFi. Gotcha. I think you and it's okay for us to see the world a little differently on a stock. And SoFi is one of those stocks where I think I've shared a few times reasons why I'd rather go with Robinhood and others versus SoFi. But I hope SoFi really does well for you. Since we're talking about SoFi, we'll take a peek at SoFi, and then we're going to look at ESTC. How has SoFi been doing? Today, not so good. Year to date, not so good. But it had been climbing. It had been kind of going up. So it's up 48% since April 8th. So look at that. You bought some shares back then. You are a happy camper. Over the 1 year, look at that. Man, 109%. Beautiful. That's a good rise. Yeah, I could see why you like SoFi. All right, so let's take a look at ESTC. I have no idea what this company does. Elastic. Okay. Elastic is a search artificial intelligence company, provides software platforms to run a hybrid public and private clouds, multi-cloud environments in the US and internationally. It primarily offers Elastic's search AI platform, a set of software products that ingest and store data from various sources and formats, as well as perform search, analytics, visualizations on data. Okay. And let's take a look at their website real quick. So what are the so here's solutions. These guys are a software company. Okay. Okay. So generative AI and RAG, this is ways for you to search documents in your enterprise. Like if you have a bunch of documents, that ability is the ability to search those documents. Vector databases are part of the whole AI architecture. So you have large language models, you have databases. We need to be able to label a database so that you can have an AI application quickly get to the information it needs to provide the user the information it needs, and it uses a vector database. This is an area that I work in, so I'm familiar with it. So this is what they do. Okay, cool. And so that's Elastic. Okay. And they're probably, the reason that they're being used is when a company wants to do AI searches on their own proprietary data, their own private data, they don't want to put it out to like ChatGPT because that's all public data. It's searched, ChatGPT ingested all public content on the internet into its large language model. That's why it was so expensive. But these companies have databases and they want a product like Elastic or a solution to enable them to securely search their own repositories of data. So that's why they exist. Let's take a look at their fundamentals. So I understand their use case. I think their use case is there. I think it's growing. So got no problem with that. It's a tiny cap, 8 billion. Revenue is pretty good, 1.48. So you're only paying about 6 times revenue. That's a surprise. I would think that a company in this space would be more valuable. Forward P at 34, that's a surprise. I would have thought this would be more valuable. So I think we're going down the right road here. Analysts think it's discounted. Okay. 1 year. Now, these guys IPO recently. Looks like, no, they've been around for a little while. So that's good. Got plenty of data. So they've been around for a while. Stock hasn't been a huge success for investors. It's down 30% over the 1 year. Yeah, this is a stock that as I look at it, I keep getting more and more interested. So their growth rate isn't fabulous, but it's good. 17% revenue growth on a $1.4 billion revenue number. That's not bad. It's not stupendous, but it's good. All right. Let's take a look at their gross margins. Gross margins, that's a nice number, 74%. Man, I'm liking this stock, Mike. I am liking this stock. So I'm not too worried about these margins because they're small. The company is small. As they get bigger, those margins are going to fatten up because you have this gross margin number that's nice and big. And I think this company is a big takeover target, being acquired by another bigger company. Okay, so I like what I'm seeing. They do free cash flow, 261 billion. So this business, I'd probably go 30 against that number. And we've got 261, so 10 would be 2.6. So I'm up to about $7.8 billion in market cap value. Let's take a look at their balance sheet, see what they got there. So balance sheet, we got cash of 1.4 billion, debt of 600 million. We got net cash of 800 billion. So 7.8 plus 800 million is going to bring us up to $8.6 billion. And they're at $8.4 billion. So this business is not discounted, high level. This one might be fun to do a full analysis. Why don't we go do that? I like their business a lot. This is an area that is in high demand. If we think about, obviously AI is red hot. A lot of people are expecting that AI is going to be big. And these guys are right in the middle of it. Now, one thing I didn't look at is where are they located? Let's take a look at where they're located. The Netherlands. Interesting. Okay. And the Dutch do produce a lot of software. So do the people from Germany. England also produces good software. So, all right. So this is Elastic. So let's go ahead and start a valuation and kind of look at this a little more holistically. Because I do like their business a lot. I want to make sure I understand. I'm probably going to just follow this company because I think it's interesting. So we're going to look at a company that is a software company. And the company that I'm going to compare it or start as a kind of template will be Viant Technology. This is a small company, small cap. I like the company. I own their stock. Doing okay with it. So let's start with that as a template. All right, so we're going to start with Viant being the example, but we're going to fill in the data for ESTC. All right. So this is these companies are smaller, right? So I'm going to keep the discount rate nice and high just because I want to be paid more money if I'm taking a higher chance, right? That is all equitable. So this is elastic. Their free cash flow over the trailing 12 months, and I've got another tab open. You guys can't see it. I showed you this data before. The trailing 12 months free cash flow was 261 million $820,000. Okay. Now they're growing their free cash flow really fast. It's growing really fast. It went from 145 million to 261. So that looks fabulous. Man, these high growth companies are exciting. All right, so I'm going to grow up by 30% for the first 4 years. And I'm going to go 35. Now this is a forecast, okay? This is my best forecast I can put together based on what I'm seeing from the business, what I know from the industry. So this is the forecast of cash I expect from Elastic. And then terminal value is going to grow up 5% because the AI space is supposed to stay fertile and valuable for a long time. Now they did have a fair amount of cash, showing that they got lots of investment, plus they're not burning cash, very important. We don't want a company that's going to run out of cash and then be a problem child in our portfolios. So they've got 1.4 billion in cash. Let me make sure I'm not dealing with euros here. This is USD. Good. Okay. All right. And then we got debt of 595 million. So we got equity value of 14 billion. We got a market cap that is not correct because the shares outstanding is not correct. Let me get the correct number. Correct number, shares outstanding, 105.53. Value per share, okay, good. That looks good. So it's discounted by 40% on cash. This is a good looking business. I like this business. Kind of wish they were growing faster, but this is totally an acquisition target for a bigger company. If their software is legit, I really like this company. All right, so let me look at their forecast. Their forecast is that they're going to have a $2.13, and we are in their fiscal year 2026, because they have a fiscal year that ends April 30th. So the fiscal year 2025 already ended. It ended April 30th. So now we're in fiscal year 2026. They're supposed to do $2.13 a share. They are a hot business. I think they're in the right industry. Growth rate, they're not going to grow that much. So I'm going to go with 10%. And they are fairly priced. So This is a discounted stock. This is a good looking stock. I like this stock. I'm going to watch this stock and I'm going to sleep on it and probably on Tuesday make a decision if I want to start buying into this stock. But I like a couple of things about this. Let me get to my, so I'm going to put this there and then just to make a note that I'm going to come back and finish this later. But let's take a look at the desirability of elastic. Okay. So this is elastic. Okay, perfect. And then we're going to go here. All right. So I happen to work in this space. So I have I have knowledge of what elastic does, why they're important. And if AI is going to get gigantic, if it's going to be big, elastic's going to have a very important role to play. So let's take a look. So this is the desirability of companies. I like to do this just to see what kind of company I'm potentially investing in. So let's take a look. So elastic is here. Let's scorecard. It's two areas that I look at for its desirability. One is its moat, its competitive advantage, its ability to keep competitors out of their marketplace. And second is its ability to grow, profit, and create cash flow. So start with the moat, competition. So they are, right now, this space is new. There are competitors, but I would say that this is so new and so big that there's a lot of addressable market for all these players. So I'm going to go with a B because they're not gigantic. Network power, not very good. I should say, I'm going to leave it as a B just because they're in the right place, right space. Balance sheet's very good. Revenue growth is okay. Profitability is good. And then free cash flow is very good. So I would say that the moat isn't as strong as I would like, but they are really profitable. So they're dipping into the gray, but mostly in the green. I really like that they're in a space that's really growing. I really like that they're a acquisition target. There's some really nice desirables. I really like their balance sheet. So long as I get a really nice discount, I would be a buyer of Elastic. Totally. These guys are part of the future. They've been around for a while, so their technology is probably the real deal. But all the things they're talking about on their website, that's BitGo. Did I already close out Elastic? No, it's right here. Okay. So all these things that we're talking about, these are building blocks to generative AI. This is when you look at like AI that, let's say, OpenAI or Gemini or Meta that they're putting together. They're putting together these large language models. And these large language models look at all public data. But where AI is really going to make a big impact on businesses is if they can use their own data that's private. They don't want the world to see their private data. And they can answer customer questions. They can help employees get to the right information so they can do their jobs faster. And that's going to create a lot of efficiency. So these guys have the right tools to do that. Now the search, okay, there's other companies that do this. Security, got it. Other companies do that. Observability, okay, good. So they have the right solutions, okay. The other thing too that I like is they're in Europe. Software companies tend to be, in most cases, American, right? Well, what if you're like a company with private data in Germany? Well, you might be a little more comfortable having a Dutch company being your solution provider instead of a company way on the other side of the world that's headquartered in Silicon Valley in California. So there's just a lot there that I like, and it's discounted. Now, the market isn't overly excited about the company, but I'm seeing value. So I'm going to watch it. I might even throw a little capital at it. And I'm going to thank my friend Mike if I make money. So we'll see. And so Mike started a small position in the STC. Man, I can't argue with that one. I think it's a pretty good move. Everything I'm seeing looks good. That's a good one. Thank you, Mike. That's a really interesting one that you brought to the table. And have fun with your grandkids. All right. So let's see if I missed any comments. I see comments coming in. Give me a little bit of time to catch up here. Okay, so we got SoFi and then Shadow Guy. So BitGo has raised 171 million. Okay, cool. And Saeed. Yeah, you know that I noticed that around Zim. Isn't that interesting that Zim is a Israeli company, by the way? And I think that the reason why Zim stock took off is the shipping routes, right? Routes that were going to be sail near these areas of tension, they're going to have other routes that they're going to have to sail. And those are going to be more expensive. And the rates are going to go up and so forth. So I think that's why the Zim stock took off. It was a nice takeoff, 5.67. And it's not going to pay a 48% dividend, I don't think. I'd be happy because I own a few shares, but I think it will pay a dividend. And I think that my expectation is shipping rates are going to go up. Volumes would probably go up modestly, but I think the rates are really going to go up. So, all right. So Zim had a very good day. What's it been doing over the last 5 days? It's back to even. It provided a really nice, I bought shares here. Thank you, stock market. I love it when the stock market gives me nice discounts. Man, stock market, I love the irrational behavior at times because my Zim stock's doing well that I bought just a couple of days ago. So Commander X. Can't argue with you, buddy. I think you nailed it. I think that's, you probably wrote it better than I said it. So thanks for saying that. Mike owns DSP. I own it. Have fun with your grandkids, Mike. Joey, how are you, sir? Have I heard of Zeta? I haven't, off the top of my head. Cream Biggins, our newest member of the channel. How are you, sir? Let's take a look at Rivian. And let me say hello to Tony. Yeah, conflict usually helps shippers. I agree. Because for two reasons. One, the rates go up, but two, they have to sail different, longer routes. Like, hey, we've got to avoid these areas, so we have to sail further. We're going to charge the customer more money. So they automatically get higher revenues at higher rates. So that's all good for them. Right, Rivian. This company is actually headquartered near where I live. They're, believe it or not, they're headquartered, I believe, in Irvine, California. Irvine, California. Now, if you guys are familiar with Southern California, Irvine, California is not an industrious area. It has no resemblance to like Detroit or any other car, manufacturing region of the world. But I think all the IP was created there, and then they manufacture elsewhere. So Rivian is a really interesting company. The things to like about Rivian are that Rivian is partially owned by Amazon. It was partially owned by Ford, but Ford sold their stake. And Amazon really likes the idea of electric vehicles, but specifically electric vans that enable Amazon shipping or Amazon delivery drivers to to use a electric vehicle to deliver products or packages. So that's been their number one customer. I think all their vans end up going to Amazon. So they have one of the world's most desirable customers, Amazon, as their principal customer on the commercial side. And of course, their cars are quite popular by consumers. I would also say that Tesla has created a lot of controversy for themselves, right? With everything Elon Musk has done over the last, I guess, 5-6 months, it alienated a lot of their clientele. And I think probably people are like, well, I want an electric vehicle, but I don't want to buy a Tesla. I'll buy a Rivian. So there's probably a bump in revenue going Rivian's way. Now, the negatives are that I believe a lot of the incentives to buy an EV have gone away. And Rivian, you're going to have to pay full price for this car. You're not going to get like a tax credit from the government, no government assistance to buy this EV, which may not be a big deal, but it's just reality. Now, this company, market cap 15 billion. They were much higher at one point. Look at that. Remember I was talking about IPOs. I don't buy IPOs because look at this one. It IPO'd, it was $130 a share. When they IPO'd, I think they delivered 3 or 5 units, cars, right? And when they IPO'd, they were the second most valuable car company in the world. That's how nuts their valuation was. But since then, it's gone down about 90%. So oh well for being the most valuable company in the world. But even at 15 billion, if you compare it to like, let's say Ford, right? Ford is not that valuable, 41 billion. And this is a gigantic company. Look at the revenues, $182 billion in revenue. Isn't that big revenue number? When we look at Rivian, it's a $5 billion revenue company. So they're a tiny fraction of what Ford is, but they're a big market cap because they're in EVs. They kind of have a better forward path with the future. Now, the revenue hasn't been awesome, right? You had really high growth when they went from nothing to something. But when you have 12% growth rate on what was a big number, 4.4 billion, but I think their go forward revenue is probably going to be better. So look at that, 2.99. That's Q1. But I think more customers are going to start going to Rivian now that, I think Elon Musk has kind of created a bad thing for the brand, for the Tesla brand. These guys will probably get a couple more sales from customers that don't want to buy a Tesla. Now, when we look at their free cash flow and profitability, they're burning cash. That's not good. The reason they're burning cash is look at this gross margin. They don't even make enough money when they sell a car to cover the materials they put in the car, the labor, the direct cost, and the direct burden. This doesn't include the engineering cost, doesn't include the back office cost of operating a business. So this is like the fundamentals are terrible, really bad fundamentals. And they're never going to be like the reason I'm excited about, the company we looked at, which was Elastic, was margins of 75%, gross margins. Those are great. Over time, when they get bigger, a lot of that money is going to end up in the profit line, net profit. It's going to end up in the free cash flow pile. But car companies, they just don't make a lot of money. They just don't make a lot of money on gross margin. 1 second, everybody. So car companies are just a tough investment, and this is why these margins are terrible. Even if they were to get much better, I just don't expect this business is going to be all that valuable. Instead of going to Rivian, I'd rather look at BYD or XPeng in China. And here's why BYD. BYD produces the batteries that they sell to other car companies. So the actual component of the battery pack that goes in a car, I like that simplified product that they can build a lot of units of and make lots of money. I like that model better than building cars that are going to be delivered to an end customer or commercial vehicles in the form of an EV van. So those types of things are what go through my head when I look at Rivian. I'm not going to be an investor in Rivian. I think it's the fundamentals just scare me off. Not a good investment. And I know Kareem Bigham's, getting to know you a little bit, knowing your age and your intent. I'm not. That's like I have a 25-year-old son. I manage his portfolio. This is not a stock I would buy for his portfolio. Not at all. The elastic stock, maybe. Coinbase, maybe. I mean, there's a lot of stocks that excite me, right? But not Rivian. Rivian is understood by retail investors, so they invest in it, and that's why they're into it. So I am not excited about Rivian. It's a sell for me. No, thank you. I'd rather pick businesses that make lots of money and are going to generate lots of cash flow and be really valuable in the future. So thanks for asking. Very good company to look at. But I'm going to give you, the way that I see it every single time. I'd rather that, maybe I think you're in Palantir and stocks like that. Let's go find the next Palantir. Let's go find it. And the reason Palantir is so darn valuable is look at their margins, right? When you look at their gross margins, 80%, beautiful, 80% gross margins. That's like freaking ridiculous in a good way. Ridiculous in a good way. And they make a lot of money. This is why Palantir is really exciting for investors, is that they have high gross margins. They can keep a lot of that profit, and investors are excited about it. So let's go find another company that looks like that in the form of their gross margins and so forth. So since you own Palantir, I could use as an example. Beware that there's a lot of retail stocks that, like Rivian, that investors can put their head around. And maybe you like the look of the Rivian vehicle. Hey, you see the Amazon, commercial vans driving around, and that you can put your head around. Okay, that's fine, but we got to match it with fundamentals. It doesn't matter that we can understand the business, that we see the trucks driving around. That's fine, but the fundamentals need to be there, and the fundamentals for Rivian are terrible. So, all right, so enough of that. Rotel and Cheese, good to see ya. And then Joey, Tony, would you want me to look at Merck's? You got it. Let's take a look at it. And then KHC. Yeah, we can look at both of those. Let's see here. KHC. Cream Biggins. Yeah, you're welcome. You're welcome. I'm glad you brought up Rivian. Keep bringing up tickers that you're interested in. Let's keep looking at them, beat them up, find the real good ones, and let's go make some money. All right, so you want to look at KHC first, Tony? You got it. Okay, so you like KHC's products, which are heavily used. KHC. So I honestly just really like the fact that probably 70% of refrigerators in America have KHC products in them. Yeah, referring to the food product, right? Okay. So Kraft Heinz. So these guys, are very well known for all the different condiments that they have, right? Obviously ketchup. They have sauces, cheeses, dairy products, meals, coffee, and other types of food products. This business is 150 years old plus, okay, and $30.87 billion in market cap. They pay a nice dividend, 6%. The 1 year doesn't look good, down 21. And I'm surprised because we've had, especially 2025, a year where consumer staples have done well. And this is a staple, right? It's a food company. Why haven't they done better? That's weird. Okay. Revenue's been coming down. That might be part of the problem, that they went from 26.6 billion, they went down, and they've come down in the trailing 12 months. Okay. So see how the growth here, they're a staple company, not very high growth. Okay, let's look at their profitability. So they're not growing, no growth. They do have some cash flow. Cash flow looks good. The best I could do is multiply times 10. So that's 31.6 billion in market cap. Look at their margins. The margins are going to be 34.5. Their profit margins are bad, 10%. That's good. Free cash flow margin, 12.4. That's very good, by the way. That's good. For a staple company, that's good. Yeah. Now let's take a look at their balance sheet, because if they have a lot of debt, that's going to be a showstopper for me. $21.6 billion of debt. Showstopper. So the business is worth 30 some odd billion, but they have debt of 21.6. That's a lot of debt. You have 2.87 or 2.79 of cash. Debt to EBITDA 3.16. So they're above. I like it to be below 3. It's above 3. It'd be okay, like, a big problem to invest in this company. They have that debt. But looking at their free cash flow and then the debt level, this stock is not discounted. It's priced at a premium of roughly 30-40%, because I add the debt that they have, which is close to 20 billion. I can get to that $30 billion of market cap through their free cash flow. But then I add the debt and I'm like, wait, that debt's a problem. Don't like it. 5-year, the stock's been hurting. It's a hurting puppy. It's not going anywhere. It doesn't grow. They're depending on people eating more ketchup. And speaking for myself, I have ketchup once in a while, but it's not like I'm drinking the stuff. I'm just using a little bit of it. Or they're the condiments. This one here is a total pass for me. If you're looking in the food category, there's other companies that could address this. I'm just not, I don't know that this stock's going to do anything. I think this one's just going to hold capital, not underperform. And I'm not interested in it. This dividend is going to lure people in. Oh man, I can earn 6%. Yeah, but if you lose almost 21%, you lost more money. You lost collectively 15%. So that's not a good risk reward. So this one's here is a sell for me, Tony. That debt's the big problem. No growth. I don't want to be sitting on stocks like this. I own one staple stock, and that is Kroger. Kroger is a grocery store. It sells groceries. It does well. It's a set it and forget it stock. Like, I like what it does. I own a fair amount of it. 1 year, up 30%. Pays 2% dividend because the stock keeps going up. Over 5 years, it's doubled in value. It's a staple, consumer staple. And there's other stocks like Walmart, Costco. It's like there's stocks out there that can kind of check the box of a consumer staple. Now, for a young investor like yourself, I'd rather you go find the next Palantir, the next NVIDIA, the next Robinhood. If you can get 5 stocks that are just going to have tremendous returns, that's going to grow your wealth. Looking for staple stocks, that's for old dudes like me. And I only have one. So for a young dude, young investor, go find 10 awesome stocks. Own those 10 awesome stocks for 20 years. Make a couple $1,000,000. That's what I hope for the young investor that is part of this community. Go find those awesome stocks, make some millions, wake up when you're 40, wake up when you're 45 and go, awesome. I learned how to invest. I sat on some winners. I made lots of money. So, and I missed everybody on Wednesday. I tuned into the member call. I usually see Tony every single time, and nobody tuned in. So I hung up, and that's fine. But Tony, if you make it next week, we can talk about it on Wednesday nights, because I know that's typically when you join. And thanks for the question. Hopefully that helped. You understand Kraft, Heinz from my perspective. All right, let's keep rolling. You've been buying a lot of Uber lately. Nice. That's a good move, man. And Uber was, and I see your comment, Kareem Biggins, and we're going to look at Nike next. So Uber, oh man, the market's like, Tesla's coming. They're gonna come out with their robo taxi, and it's gonna affect Uber, right? And then Tesla postpones their big launch. Big launch is coming June 12th. Well, that didn't happen. It's like, what kind of threat is that? It's like it's probably going to be underwhelming when they end up launching. It's going to be like a couple of vehicles, and who knows if anybody uses it. I mean, could you imagine being a rider that was like, all right, cool, I look forward to riding on a Tesla robo-taxi on the 12th. Oh, well, now you're going to have to wait. And are you going to be just as excited for the new date? Or are you going to be like, well, I'll wait and see if they really do launch, because I don't want to get my hopes up like I did last time. Anyway, Uber is up 14% for 1 year. Year to date, up 39%. But boom, nicely done. And what I love about market conditions where a stock gets really doubted is it gives us a nice discount. Boom, look at that. Buy Uber at $60 a share and watch it rise to 84. That is beautiful. So I'm buying shares of Uber on any kind of pullback because I think the stock's really, really discounted. So I really like Uber. Their growth is great. Really nice growth on a big number, 45 billion. They have just really, really good fundamentals. Look at this cash flow. Cash flow is just exploding, $7.7 billion. Really nice free cash flow rate, 17% free cash flow, profit margin at 27%. Beautiful, beautiful fundamentals. Uber is the third or maybe the fourth most valuable stock in my portfolio, and I keep adding to it. So I hope this one works, and I hope it works for all the investors that bought into it. So I left off on Nike. Man, the comments are coming in fast. Let me try to keep up. So Nike is another very well understood stock by the retail community, the average person. I have a pair of Nikes on right now. I own, 10 pair of Nikes. My kids own another 50 pair. I don't know how many pairs of shoes they have. My wife owns Nikes. Everybody knows. I'm wearing a Nike hat. Look at me. But I don't own the stock. Their revenue is coming down. Okay. And I think they pulled a lot of revenue forward here in 2021. Everybody had a dividend, a government stimulus check. Oh, I'm going to go buy a new pair of Nikes. Yeah, so they was easy to grow in 2021. But then after a while, those compares got heavy and they haven't been able to grow. And this stock in the quarterly, it's even worse. Look at that. Down 10%, down 7.7%, down 9.3%. So Nike fundamentally, the top line revenue growth, it tells me, are people excited about Nikes? Well, the data is telling me no. People are not buying as many Nikes. You know, the Air Jordan brand is getting kind of old and stale. Michael Jordan was in his heyday, you know, in my younger days. Now it's like, what's exciting about Nike? They make a very good product. I like their shoes. Good styles, good shoes. But they just, you know, I don't need to buy a new pair of shoes every month. I don't know. I buy maybe a pair of sneakers every 6 months, every year. And I have a bunch of sneakers. You know, I have old sneakers that I wear once in a while. I've had for like 10 years. And my closet's full. I can't make any more room. Just speaking for myself. I don't know if other people feel the same way. Now, so their revenue is contracting. And let's take a look at gross margins and cash flow. So cash flow is down from where it was before. I see like and I'm looking at quarterly. So let's go back to annual. Cash flow. Cash flow is down a little bit from 2021, but it is pretty decent at $5.3 billion. That's pretty decent in the trailing 12 months. Gross margins of 43%. That's decent as well. Profits are okay. Free cash flow, okay. So this stock here is probably worth 15 times cash because their brand is pretty darn good. 15 times cash minus debt. So that would be roughly 80 billion minus debt. Let's see how much debt they have. And they have cash and they basically have $1.5 billion of debt. So let's say they're worth 78 billion. It's high level. And their market cap's 89. And I think I have a full valuation on them. So let me just go there. So I'm taking their FY 2024, looking at their cash flow, and they're discounted by 8%. Now, that's not super exciting because Nike's not exciting. They're not growing. And I don't want to make 8%. You know, I want to make 80%. I want to find a stock that makes 100%. I want to find a stock that's going to double. Nike's not it. Nike's got some problems to fix. If they fix those problems and they catch a few, you know, a few breaks, maybe it's a nice 25% gainer. Maybe it's not. Maybe it goes down another 25%. But there's just not a lot there. The fundamentals are not super exciting. I want great fundamentals. I want the stock to be discounted by 50%, like Uber. We just talked about Uber. Let's go to Uber. In your new, so I'll let you know that you can refer to this sheet in the investor tools folder that I sent you a link to. You could get, you have a copy of this, so you could always go to it. Look at Uber, yeah, discounted by 50% and the stock's working. This is what I want to invest in. Nike, oh, thank you. It's kind of like my capital is just going to be sitting there collecting dust. I want to see a stock really take off. I want to feel like, and it's not even attained its intrinsic value. It's still got a 50% upside to go, and the business keeps getting bigger and better and better and better. Internationally, it's growing. It's partnering with Waymo for robotaxi. It's partnering with a Chinese robotaxi producer in Abu Dhabi in the Middle East. So there's a lot of really good things happening for Uber. That's what I want to buy into. I don't want to buy into Nike where Nike just doesn't have any momentum. None. Like, I'm not excited about it. I'm watching the NBA playoffs. Really good playoff, by the way. I'm hoping Indiana wins game 4 and really puts Oklahoma City in a corner because Oklahoma City was supposed to win. They were supposed to win easily. Well, back to Nike. I'm seeing no Nike kind of buzz or impressions of Nike. Nike's not even a part of the conversation anymore. So Nike's a complete pass for me. It looks like the stock is hurting. Investors are hurting that own Nike. Thanks for asking on that. Yeah, Tony, thanks for the comment. I appreciate you being a member. Thanks so much. Yeah, I agree with you on Tesla, but on fundamentals, the stock is expensive. So Heinz makes the best mayo in Switzerland. All right, we're covering all bases. James Sheard, thanks for joining. I have thoughts on Salesforce, but the rule of engagement is if you want me to talk about Salesforce CRM, $5 super chat or become a member, then I would gladly talk about it. Thank you. As he wears a Nike cap, exactly. I guess they're getting my money, but I guess I could switch hats. Do I know about any robotics companies? I don't. I hear a lot about that. So I think we can end on this comment. You want to invest in Hood, Uber. You're right. They are expensive. I would say Uber is at a better entry point. Hood is, man, it's just been going up so darn good. I mean, I'm a big Hood stockholder, so I'm not going to complain. But it's up 211%, right? So it's really hard to get in here. Of course, back here, hindsight's 2020. $35 a share looks pretty good, right? So, but now it's like up 100% from that point. So I get that investing in Robinhood's probably, you got to be careful because you can buy it and then it drops to 50 and you're like, damn. So I would wait for a really big pullback on Robinhood before I took a run at that. But Uber is also enjoying a good rally, but I think it's better discounted. The rally of 39%, but you see that with one solid story, the stock can really come down. And if it does, be ready for it. I certainly will be. I'll be buying shares because I think Uber is going to be a $1 trillion market cap company. Right now they're at 175. They will be a $1 trillion market cap company at some point. Good stuff. Great to have you as part of the community. Man, I had a lot of community members on this stream. Great to see you guys. I was super busy this week, handling a lot of business, which went well. But I'm glad we got a live stream in. I'll try to stream again over the weekend and host the investor call on Sunday. But everybody, thanks so much for tuning in. Good live stream. Don't let one negative day on Wall Street get you down. If it keeps going down, we'll buy it at discount. No problem. We'll buy the right companies and make money over the long haul. So that is it for the stream, everybody. Have a nice evening. Have a nice weekend. Thanks for tuning in. We'll see you guys.